Hi, and welcome to our end of October update from the Wealthy Doctor Institute, Intelligent Investing for the Busy Professional. We focus on simple, battle-tested methods of investing that require just one adjustment each month to protect and build wealth. I'm David Ye, author of my book, The Busy Doctor's Investment Guide, How One Adjustment Per Month Can Save and Maintain Your Portfolio's Health. Although the strategies in this book are easy to calculate and adjust each month, for those who are new to the concepts of this book, or for those of you who are new to investing in general, this video will try to clarify what I do every month. Feel free to follow along every month until you get the hang of it. And this month is end of October. I'm recording this on Halloween. I think the kids have finished trick-or-treating and we should have some peace and quiet recording this video. So for this month's video, we'll talk about the topic of the month. Then we'll go over our systems again. The 20-month moving average system, the MRI system. We'll touch base on the rules on the 25% trailing stop loss system if you want to trade individual stocks. And then, of course, we'll remind ourselves about checking up on Sector Surfer. So let's get started. Topic of the month. You probably know by now that my systems are not passive. We actually have to watch these systems roughly once a month, but they're not day trading systems either. And for anyone who's read any of these personal finance books, they usually come in two flavors. There's either, well, one set of books for personal finance portfolio management where you're taught to buy, hold, and pray forever, or at least buy, hold, and maybe rebalance in some kind of pie chart style of investing, or you have a more active type of investing where you're looking at indicators or some other type of mechanical system to invest. Obviously, I favor the mechanical investment systems, but yet the passive portfolio type of investment systems that are described out there are much more prevalent, and they have a lot of arguments trying to convince you that theirs is the way to go. Sometimes they provide data that seems to work, and if you just break out the Excel spreadsheet, you can see whether or not these hypotheses really do work, at least in retrospect. So a lot of times if you find something that looks good, well, let's just flip it around and see if that works as well. And then we can, once we find two sides of the same coin, we can see which side is stronger. There's a saying that goes, what have we missed because of active management? The 10 highest gain days of each year. In other words, out of the 200 something trading days each year, somehow we were unlucky enough and we missed only 10 trading days of the whole year, and they just happened to be the 10 days that we gained the most in the markets. Well, that's kind of ridiculous to assume, but that's the example that they keep saying. So yeah, what would happen? Well, if the red is the S&P 500 index and we go back to 1980, and the green line is when we were missing the 10 best days of the year, well, you can see the red line, but you can't see the green line because it just kept falling. We have to go to a logarithmic axis, like so. So for instance, every tick, instead of being linear, 500, 500, you're 10 times, 10 times, 10 times, 10 times. So you see the red line represented here. It makes a lot more sense because instead of going up exponentially, it looks linear. Meanwhile, the losses every year, because we miss the top 10 gaining days every year, we tend to lose a lot. In fact, if we were to buy, hold, and reinvest the S&P 500 Index mutual fund, we will have annualized return of 10.4% versus losing an average of 13.3% every year just by missing those 10 days every year. So the conclusion from this little thought experiment is Don't miss out, stay invested at all times. Well, when I first heard about this example, it's probably obvious to you as well. That's missing 10 best days of each year, which already is not practical. I mean, unless we had a crystal ball saying, well, tomorrow's a high gain day, let's skip it. What if we missed the 10 worst days of each year? So let's go on to this one. So if we missed the 10 worst days of each year because we somehow had a crystal ball that told us, oh, the next day is going to crash, and we missed it, what will happen? Well, we have this exponential curve, and then the original red line of the stock market is not visualized because it's so relatively low. So again, let's go on to the logarithmic graph, and here is our buy, hold, and reinvest line, and here is our what have we lost, or what have we skipped the 10 worst days of each year. Again, if you bought, held, and reinvested, you would have gone 10.4%, but if we were to magically sidestep the 10 worst days of each year, we would have increased our gains to 42.2% per year. Well, this is an equally ridiculous example because, again, there's no way we can tell which days practically are best or worst days, if anything. But this seems to show that missing the worst days is more important than keeping the best days. So, well, the question then is, well, which one is more important? Keeping the best days or losing the worst days? So here's a thought experiment. What if we missed both the 10 best and the 10 worst days of each year? Well, the red line is if we were to buy, hold, and reinvest every year. And the blue line is if we were to lose those 20 days every year, or roughly 1/10 of the entire trading year. So if we lost both the 10 best and 10 worst days of each year, we actually gained a little bit more. Instead of only making 10.4% every year, we made 11.7%. Now, if we had a crystal ball and we can actually trade like this, this might be viable, but for the sake of this exercise, all we're trying to point out is that maybe temporal avoidance has merit. And that's the basis of the trading systems that I've described in my book and which we monitor every month here. So just to compare year by year, the S&P 500 index, dividend corrected every year, if you take a look at minus the 10 worst days of each year, I mean, if you think about it, let's say that a good day you go up 1%. If you miss 10 of those, you're already missing out on 10% of the gain on average. In fact, many years you lose out a lot more than 10%, and that's why you average losses of 13.3%. Meanwhile, if you lose 1% in a day, that's considered really bad, but if you lose the 10 worst of each month, then you automatically boost your returns dramatically. Alright, so that was the topic of the month. I just had to get that out of my system. I keep seeing examples of how passive investing is end-all and be-all, and I really have to bust this myth. So, to review your system so far, first system, again, each system has its own rules, its own criteria on what to do. So the first system is the 20-month simple moving average system, abbreviated 20-month SMA system. And the rules are, if the price of the S&P 500 index is above the 20-month moving average, it's relatively safe to stay invested in the index fund. Otherwise, get out. And if you do get out, remember you have a choice of being in cash or going to bonds or some other kind of bear market strategy. The 20-month moving average is our safety belt. It only works if we watch it every month. So here's the update for this month. You take a look at this graph. The blue is the S&P 500 index fund. The red line is the 20-month moving average. As of end of day today, the VFI index, which is the mutual fund that we're using, closed at 196.54 per share, and the 20-month moving average has increased to 190.16 per share, which roughly translates to a 3.3% cushion. In other words, if the markets fell more than 3.3% at the end of next month, then it would probably be signaling a time that we need to get out. But right now, it's above the line, so our system is saying it's relatively safe to be in the markets right now. So far, just by that one observation, we see that even though the S&P 500 decreased and the 20-month moving average increased, it's still relatively safe to be S&P 500 for this month. The cushion has decreased. It used to be 6%, now it's 3.3%. But we just watch once a month. Let the markets tell us when to get in or stay in or get out. And remember, we have an event coming up on November 8th that can potentially change the direction of at least the US markets. As usual, wait until the end of the month for the potential action or signal. Don't jump the gun in the middle of the month. Just a pre-warning. This has been a crazy election cycle and crazy year so far. Now more than ever, stick to your guns. Watch this only once a month at the end of the month. Next system is the monthly rotation investment system, abbreviated to MRI system. And the MRI rules every month rank 3 funds: the VFI index, the S&P 500 index fund, the VEIEX, which is the emerging markets index fund, and the RYURX, which is the inverse S&P 500 index fund. Every month, sell the bottom 25% of your portfolio and buy the top fund. So here's how we did so far this month. From the end of last month to the end of this month, the S&P 500 index mutual fund actually drifted down almost 2%. The emerging markets continued to go up a little bit, 0.6%. And the inverse fund, because the index fund went down 1.8%, the inverse fund actually went up 1.8%. Now, for those of you who are looking at the actual numbers, you probably noticed that the end of October, the actual prices jumped from 13 something to 72 something. That's almost exactly 6 times, and that's we're probably going to find out tomorrow or something that there was a reverse stock split. In other words, instead of one share splitting into 2 or more shares, for every 6 shares, they combine to 1. And sometimes they do this just to make shares easier to track. If you invest in individual stocks and there's a reverse stock split, it's usually because stocks got so cheap, it's actually easier to just combine multiple shares, like maybe 5 shares per one or 10 shares per one, and bump up the share prices each. But in the case of this inverse fund, remember it's still a fund, so it's not saying that there's general weakness in the particular stocks, just that the general trend of the markets, it's easier for them to just reverse stock split. So last month we were 100% in the emerging markets fund. This month we're supposed to sell 25% of our lowest fund, which is the emerging markets, and then buy the inverse fund. So we end up with 75% emerging markets, 25% inverse fund. So the observations of the month so far: the US markets are getting more volatile as the emerging markets are beginning to settle down. Having said that, overall volatility for both the US and the emerging markets continue to decrease. There's a squeeze in the volatility. This is what the traders call coiled spring. In other words, as volatilities get smaller and smaller, eventually something's got to give, because we can't just flatline forever. Something is either going to make the markets go up or down in a more likely a very volatile fashion. We can't tell just by looking at the volatility which direction it would go. However, we do know a couple of things. Number one is that there is a date, November 8th, that might give us the impetus for the market to suddenly go haywire on us. And at the same time, now more than ever, stick with our guns, watch this only once a month, because when it goes haywire, it could go jagged up and down, and again, could cause whipsaws. We don't want whipsaws with our system. If it whipsaws on a monthly basis, okay, it's just our system, but don't watch this daily. Just a pre-warning. So our next system is the 25% trailing stop loss system. This is a system that we apply to individual stocks for those of you who really want to invest in stocks for some reason. For the trailing loss system, it's also called the 1% risk trailing stop system. There is no standard name for this. It's a very common way that traders actually position size their stocks. If you really want to buy a stock, remember to limit your total risk of your portfolio to just 1% of your portfolio, 25% per stock, 1% portfolio. So in other words, you can buy up to 4% worth of your portfolio in any one stock and immediately enter 25% trailing stop loss. If the stock goes up 33%, buy another block of stocks using another 4% of your account. Otherwise, repeat until stopped out. Next system, completely different system, is our sector surfer system. It's, well, not ours. It's another company that produces a sector rotation system. I've introduced this back in June. The good news is if you are using the system, it would either text or email you, depending on how you set up, any signals that may have been generated since you started. Now, just a caveat, for those of you who are doing sector surfer and you're not monitoring this as often as we should, at least make sure that if you are using Storm Guard armor, we've been in the danger zone of the market so far. At least if you use the S&P 500 index in any of your portfolios, you might want to check to make sure that you are in your bear market strategy. In other words, when Storm Guard armor detects as dangerous to be in markets, you can choose to be either in cash or in bonds or in some other kind of strategy that is relatively negative compared to the overall stock market. But again, you might want to check this at least once a month just to make sure you're not missing any signals. So if a sector surfer strategy is set up properly, you will get a signal through email or text. I log on roughly once a week, but at least log on once a month just to make sure you don't have a pending trading signal. And if you do have a sector surfer strategy that uses the S&P 500 index, your Storm Guard armor indicator is likely still indicating danger in the markets. So in summary, remember, I just went over 4 different systems. Don't mix up the systems. Don't use one rule from one system to apply to another one. That's mixing systems, and that means you just destroyed whichever system you're following before. So remember, you have the 20-month simple moving average system, the monthly rotation investment system. If you have individual stocks, there's a system dealing with stock tips, and then just a quickie monitor of your sector surfer strategies, and that's it for the month. So keep those questions coming. I know I talk to several of you personally every month, but for those of you who have only heard about me indirectly, or maybe you got a copy of this video forwarded to you by a well-meaning friend or colleague, here are ways to get in touch with me. Give me a call, drop me a line, set up an appointment for a consultation. A few of you that I've talked to, you know your stuff, you're fine, I don't have to worry about you. But for some of you, holy cow, it's clear you need help getting your financial life in order. Don't be bashful. reaching out for help. The more you delay, the more time is against you. So, until next month, invest safely.